Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Tellurian, specifically about the downside protection that I believe we have with Tellurian stock based on their valuation as a gas producer. Before I begin, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Tellurian, and in case I mention them, I also hold a long position in Next Decade. So basically this video should be for your entertainment purposes only, because I could be wrong about everything I say in this video. You need to do your own research before making any investment decisions. So, Tellurian and downside protection. We know that the stock is trading, $4 and change right now. It goes up and down, but one of the interesting things about Tellurian that you do not have, let's say, with Next Decade, is that even if something catastrophic happens and they are not able to move forward with Driftwood, they never build the facility, they're at least generating revenue right now. And they could turn that into a company, right? I have to imagine somebody would salvage this and say, hey, we still got something going here. Sure, it's not Driftwood LNG. It's not going to be a $20 billion company, $50 billion company. We have all kinds of predictions. But we still have something. This company is not just, okay, we tried hard, guys. Let's call it a day and disband the whole thing, right? They do generate revenues and they could turn this into a viable business, probably as a much smaller company than what they've scaled up to today. But it is a path, right? And this is where I view that Tellurian stock has some of this downside protection in a way that Next Decade doesn't, because they do not produce revenues. They don't have anything right now where if all the funding dried up and they were not able to, it was clear that they were never going to be able to, get their LNG facility, Rio Grande, off the ground, and that their carbon capture stuff wasn't viable for some reason. Obviously it's hard to predict exactly what you do. The company might pivot once again into something else, but, on the surface of it, they don't really have anything to salvage. It's probably easier for them at that point to just call it a day. And, if somebody wants to start something else, they would probably be a new business without all the baggage of what they have right now. So what I want to look at today is, let's try to estimate how much this downside protection is. So what I did was I looked at a couple other small to mid cap gas producers. Specifically, here are the tickers right here. And what I did for each one of them is I went to Yahoo Finance and I grabbed their market cap and their enterprise value. So that's where the source of these numbers come from. And then I also looked at each company's investor presentations, and I tried to get what their 2022 estimated gas production was in terms of BCF equivalent, right? BCFE for the year. And there may have been one company that didn't give a guidance for the full year. And so I think I just took their Q1 numbers and multiplied by 4 because it's in the ballpark, right? All I'm trying to get here is a rough valuation. If we looked at Tellurian as a gas producer, what would they, again, roughly what would they be valued at? This is not a, discounted cash flow. This is not a very principled way to do things. It's just giving you a ballpark, right? To try to estimate at the end of this, if Tellurian had to be, salvaged as a gas producer, are they worth 10 cents a share, or are they worth, a dollar per share, or are they worth, more or less? So let me go through it. So I looked at that. I have their production capacity for each one of these companies. I have their market cap. And then I divided their market cap per, by their BCFE to say how much market cap do they have per, unit of production. Then I also did the same thing for enterprise value. That's really going to base my valuation off of is enterprise value, because these companies have quite a lot of debt. You can see, I have it on a chart down here. The blue bars here are the market cap. The red bars here are their enterprise value. And so you can see there's quite a difference to the point where some of these are, I don't know, not quite double enterprise value, but certainly double-digit percentages higher. And then the yellow bars here represent the production. Those map to the right y-axis here. And so you can see that there is a pretty, a correlation, as you would expect, between enterprise value and their production capacity that they expect in 2022. It does actually range a fair bit, where you can see that I think this was Southwestern, that their production, relative to these, you can see that yellow bar is lined right up with that red bar, and whereas these other ones are smaller, they're not given quite they're given more credit for their production value. Anyways, so when I divide that out, I use that, and then I just multiplied by what Tellurian's production capacity is estimated to be at the end of this year, which is 73 BCFE. And I got that from their Q1 reports, right? They say at the end of the year, they believe that they're going to be at 200 million CFE per day. And so you just multiply that out, and hopefully it comes out to 73. Hopefully I did my math right. And this is their current market cap, is 2.5 billion. And the predicted market cap that I would get based on Tellurian's 2022 end of year estimated production is in this range here. Right? You can see between 790 million. I should put millions of dollars is what the units are here. Up to 1.2 billion. And again, this is ranging depending on the valuation those companies have. And so visually in a chart, what that looks like is this. And I actually put together two data points, one at their end of 2022 production. And then I put another one given the same valuation per unit of production. If they go with the same run rate of adding 100 million cubic feet equivalent per day of production capacity in 2023 as well. And if they are, if the market is forward looking and values them at 300 million cubic feet equivalent per day. And so that's what the red bars are, which is even higher. And maybe that's not really a fair comparison, since I'm sure some of these companies, are probably increasing their production, and the market is giving them, some additional credit for that production capacity after 2022 that will come online. But I didn't do a deep dive into this, but I'd be a little surprised if any of these companies at their scale were growing 50% year over year in terms of production capacity. I could be wrong, and maybe there's a lot of growth built into some of these numbers. But for Tellurian, they are going to go this year, I think, more than doubling the capacity where they are, or their production capacity where they are from the beginning of the year to the end of the year. At least that's their estimate. So I think it's fair to assume that that's probably a higher growth rate. And so this just gives you an idea of what it would be if it was actually 300 million cubic feet equivalent per day. So that gets you to these. This is estimated market cap. And by the way, one other thing that I want to mention there is these companies all have debt. Tellurian has, effectively very, very little debt at the moment, at least at the end of Q1. And they had some cash on the books, right? Because they've been diluting, they've been selling, and they're using that cash to build driftwood. This is just, again, this is your downside protection, and none of us really want this to be the case, right? If you're invested in driftwood, I assume you are not invested to value them as a gas producer, and you want driftwood to happen, right? And that's obviously I do too. This is just a way to think about, hey, if something happens, right? If we hit this, there's a lot of news stories about, hey, we're heading into a horrible recession. If we had another 2008 type event and, financing just totally dried up, it's kind of just it's a possibility. I think it's small. That's why I'm still invested, but I think there's a small possibility that driftwood, doesn't happen. And so if it doesn't, what would we be holding? Would it be, would we be holding, a 1 cent stock that's just waiting to actually officially declare bankruptcy? No, right? This is how we value it. So this is how I value it. This gives you, again, their market cap, because I'm adding on that sort of net $240 million of cash here on top of what the enterprise value would be. And then if I divide that out by 552 million shares that they had outstanding at the end of Q1, which is probably a little low. I'm sure they've been, they probably sold some more since then with their at the money offering. But again, I'm just looking for ballpark numbers today. So if I divide that out, that actually gives us, a rough share price of somewhere between $1.43 to $3.06. Again, just on this model. So that gives you at least an idea that even if something happens, I think there's some downside protection where you can see, this is what it looks like visually. You can see the prices you would have based on the valuation numbers from each of these underlying stocks, and then what that would be if Tellurian was valued at, either 200 million cubic feet equivalent per day of production or 300. That's what the blue and the red bars are here. And so that's really the bottom line here, is to say that there's still some downside protection. And one other thing that I want to, hugely call out here, if you're really thinking downside protection, is this assigns sort of a zero value to their holdings in Driftwood. Because even I think there's still some value, right? Clearly, it's not a $20 billion asset if it's, a partially, started construction process on a site. However, that's not to say that, in a horrible situation like this where Tellurian can't make it happen, that there's not still value in that site, there's not still value in that plan and the permits, that they could sell that off to some other company and probably capture a good chunk of change just in that transaction. And again, I have no idea how that would be valued. But that's just one more aspect to think about, that, this valuation here is just if Tellurian says, all right, great, we're going to downsize the company quite a bit. We're going to be just a gas producer and sell into the market. Or, be similar to these other companies, right? But the point is, I think there actually is some other value that's not even represented in this model, which is the value of Driftwood, the Driftwood plan and assets and permits itself. So that is what I wanted to cover today. That is my how I think about the downside for Tellurian stock. And so, if you're buying it at $4, $4.50, whatever it's trading at today, you might be thinking that this is a reasonable estimate of what your downside could be for the stock. Again, not financial advice, is just how I think about it. So think about your risk and reward that you have there. All right, let me check and see if there is anything on the chat. Nothing on the live chat. If you're still watching up to this point, just as an FYI, I do these videos live, usually around 10, 11 p.m. ish Eastern US time. So if you're interested, and I do that usually Sunday through Thursday night. Usually don't do them Friday or Saturday. I don't hit every day, but I do try. So if you're ever interested, feel free to hang around and hop on, and I'd be happy to to chat with you. I love it when folks hop on here and chat. But anyways, feel free to critique me or give me your opinions or thoughts in the comments below. Even though we're not doing this live, it's still fun to chat with people after the fact. So, all right, I think that is everything. Thank you very much for watching, and have a good one.